Have you ever looked at a multifamily deal and thought, how do I really know if this operator knows what they're doing? In this episode of the Passive Income Playbook on the Best Ever CRE Show, we are breaking down exactly how to think like an operator and how that can make you a better passive investor. I'm your host, Pascal Wagner, and today we're joined by Matt Piccini, a seasoned multifamily GP with over 16 deals himself and over 28 deals as an LP under his belt. And fun fact, he's a best-selling author and an Tony Award-winning Broadway producer, something I'd like to get into here in a minute. Matt, when he's not running his own deals, he's also coaching new operators through their first syndications, giving him a front row seat to what makes a good GP and what separates the amateurs from the pros. If you've ever wondered how to vet operators more effectively, avoid common red flags, or just learn the type of multifamily that Matt is investing in, this one is for you. And with that, let's dive in. Welcome, Matt.
Thank you. Good to be here.
Yeah. So, before we get into to who you coach and the strategy that you pursue with your firm, I think one of the more unique things about you is that you are a Tony Award-winning producer. So just can you fill us in? What does that mean, and what does it take to get there?
Yeah, well, it took a long road to get there. I grew up and was always interested in theater and actually wanted to pursue a career in theater. And that I grew up in Orlando, Florida. I moved to New York City 1992 to pursue a career in theater and was a professional actor actually for a number of years. I always wanted to win a Tony Award for best actor. That never happened. But fast forward many years, after I got involved in, I was an actor, and then I was in digital marketing, and then eventually I got into real estate. And I met a lovely woman and we got married, and she works full time in the business of Broadway. And she and I have teamed up together a number of times to support shows that we really like, that we really feel good about. As an example, we have a show that's in development right now that we don't know if it will make it to Broadway or not. We're on that journey, and it's already been a few years, and we'll see where that goes. We're excited. It got picked up by a regional theater, and it's going to be done early next year. But we were involved in David Byrne's American Utopia, and we were also involved in Moulin Rouge, and both of those won Tony Awards for Best Musical. And if you're a producer of a show that wins Best Musical, you get the Tony Award. Like, as you know, when you watch the Oscars, the Best Picture, the person that goes up to accept it is the producer.
That's awesome. That's what a unique history. So
Yeah.
I want to understand, I think when I think about, being an operator in real estate and being one of the firms that raises a bunch of capital, and for those of you listening, if you don't follow Matt on Instagram, you should, because he is crushing it. I think it's great content. Matt's actually one of the people who I wanted to follow in the footsteps of. So I'm actually happy to have you here on the show.
That's very kind of you to say. Thank you.
Yeah. So I'd love to, interesting dynamic coming from theater. Help us understand, how did Matt get to where he is today?
Well, it's interesting, Pascal. I actually wrote an entire book that chronicles that journey, because it wasn't something that just happened overnight. Like, oh, now I want to do real estate. It's something that started a long time ago and grew gradually over time, and then got to a point where I said, now I want to make this my full-time job. Right now, I really want to do real estate full-time. And I wrote my book to sort of share that journey and to help specifically limited partners, people who are interested in investing in real estate syndications. And I specialize in multifamily, but people who don't necessarily understand the nuts and bolts of how it works. And it's called Backstage Guide to Real Estate, because I'm trying to sort of like peel back the curtain and let people kind of understand, number one, my journey on how I got to where I am, but number two, the mechanics of how these deals work from a high level, but enough to, I think, hopefully, when you're looking at an opportunity, be able to sort of understand deals that really are good versus ones that aren't. I mean, it's, as we all know, it's not just like what is the equity multiple or the cash on cash that's going to really make a deal work or not. It's what are the assumptions that we're put in that underwriting to come up with that number. And I wanted to kind of give people a little bit of a look into that.
Yeah, I love that. So how did you transition from theater to doing your first deal, and what did that look like?
Well, as I mentioned, it was a very long story. I'll give you the very very quick thing, but I was an actor for many years. I then got involved during the .com heydays in developing websites, and then ended up doing marketing. And I was in the marketing world in New York City for many years, and started doing real estate on the side as a hobby. What happened was I had my own boutique agency doing website development. The .com bubble burst in 2001, and my business completely imploded. All of my clients were either going out of business or not putting money into any development projects. And at that time, I got a phone call from my landlord, and he told me that I had 90 days to get out of the apartment I was living in. So I needed to find a new place to live, and I didn't have a job. So I got myself a job. Actually, Showtime, the television channel, they offered me a position in house. I had done some work for them, so I went to go work at Showtime, and I found a place to live. But instead of renting another apartment in New York, I actually bought a place. I was way up in the Washington Heights area. Actually, so I did do another, I wish I knew the episode number because I would mention it in here. You could probably put it in the show notes, but I did a whole interview with Joe Fairless, actually, and we talked about this deal and went into the nuts and bolts of it. But I basically sold the property in about little less than 2.5 years. It was a property up in Washington Heights. I bought it, made some renovations, did some things on it, and sold it in a little over 2 years, and more than quadrupled my initial investment. And that was the big light bulb moment for me, where I said, oh, you know what? I need to figure out how to do this thing again. I mean, I was working at Showtime at the time. I was making a very nice salary, 6 digits, and this is back in 2001. But the one real estate transaction, I made more than an entire year's worth of salary. So that was a light bulb moment for me. I said, I need to figure out how to do this again. And I spent the next 15 years trying to figure out how to do it again.
I love it. Love it. So got into doing your first deal, made some money, and then I, from there, was it an automatic light bulb moment of like, oh, I'm going to start raising capital to do this, or did you have to have another kind of experience to figure out like, okay, I need more capital to scale?
Yeah. So after that first deal, I started doing some deal, that was a primary residence. And then I bought a new primary residence. And then I did my first, what I would consider my first real investment, which was a home that I built, and it was a short-term rental property. And then I started fixing and flipping properties, and realized, so we had to move. My wife had a tremendous job opportunity. And when we moved from New York to Miami, Florida, and by the way, just to make things more confusing, I am back in New York now, but we moved from New York to Miami. I decided that I wanted to try to do real estate full time. I've been doing it as a hobby, and it had gone very well. And so when I started looking for opportunities, that's when I first found out about real estate syndication. And that was another, moment, a light bulb moment for me, because I had always wanted to do more and do real estate sort of full time and go bigger, but I didn't have the capital to do that on my own. And I didn't have some rich relative who would give me millions of dollars. So I didn't know how I was going to, bankroll an operation like this. I heard about real estate syndication, where I could work with other investors and pool capital together, both from an investment vehicle myself. And I invested as a limited partner in a number of deals while I was looking for my first deal, and then eventually found the first deal for me to be a general partner. And then I brought out to investors, and then kind of grew from there.
Yeah. So I'd love to kind of touch in on the LP side, because you do both. I think that's one of the things I like to highlight, is that many GPs or operators don't just do their own deals. They also believe in diversifying into other asset classes, other operators, other strategies, and even, as I learned before the show, even other asset classes like maybe Broadway producing shows. That wasn't included in the original LP investment figure. So you did some real estate, quadrupled your money, started learning, trying to look for your first deal, got into your first LP deal. I imagine that taught you a lot about first off, just getting the experience of doing your first deal, but also probably maybe insight to what could go wrong or maybe what strategies to pursue. Can you talk a
Well,
little bit to that?
it's very interesting that you say that because I know you don't know, but that deal did go wrong actually. So it's great that you brought it up. I actually wrote a whole chapter in my book about this particular deal because I learned so much from it. Yeah, I mean, luckily when all was said and done, I didn't really lose any money. I mean, maybe I lost sort of opportunity cost because I had money sunk in this deal and we walked away with basically the same amount of money, but there was no, I didn't really lose capital. So that was good. But I mean, I learned so many different things from that. I don't even know where to begin, but being able to really understand who an operator is, what their track record is, and really being able to vet operators well, but also being able to understand the market and see what's going on in the market and take a better look at a business plan. But I mean, I didn't just learn from that deal. I've learned from every single deal that I've done, both as a limited partner and as a general partner to this day. I make mistakes and I learn from them all the time. And I think that's, part of life and part of business and part of growing. But yeah, I learned a heck of a lot. And I'll tell you, I'm a much better LP than I was back then. But I still, learn things as I continue to experience life and invest in these deals.
Yeah, was there maybe like I'm gonna try and pull some out of you. Do you think I think back to my first kind of LP deals. It's like I didn't know what a track record, quote unquote, meant. I didn't know what kind of communication I should expect or how to ask for previous investor emails or really understand like what assumptions to dig into, or were any of those kind of core pieces to that?
Sure, sure, they all were. And sort of the talking about the assumptions and what to dig into. That's kind of like what I share in the book, and also I have a bunch of free resources on my website where I share that information too, because it's important to dig in to those things. So yeah, I mean, I did learn some things from that. It's hard for me to compartmentalize on the spot just
Sure.
because I've been quite a breadth of things that I've invested in. But, the legal documents was it was my first time reviewing these legal documents. And my eyes crossed and I must have fallen asleep 18 times while reading those. It was my first time trying to go through that. Now I can go through them very quickly because I understand them and have reviewed several ones. Even if when they're done by different attorneys, they tend to sort of follow a similar format. But yeah, that I mean, there was a big learning curve there. One of the reasons why I invested as a limited partner, now I knew that I wanted to be a general partner, and you don't have to be a limited partner first to be a general partner. But I wanted to understand how other operators were operating and sort of take best practices from them. And I also was very clear with all the operators. All of them were people that I had gotten to know, and they all knew that I wanted to be a general partner and that was my aspiration. I was very clear with them about that, and that I might even ask them if I could hop on a call with them from time to time in a non-obnoxious way to ask them if I had specific questions. And they said, yeah, of course. And so I did. I invested in those deals and I got to see the communication. Some people were sending out great communication. Some people were not sending out great communication. And I took what I thought was the best of all the different things that I had seen, and I incorporated that into the way that I worked in my first deal as general partner. And then over time, I've continued to evolve that. And whenever I see something that I think is new as an LP that I like or appreciate, I try to incorporate that into my business practices because I think that, I want my investors to have a wonderful experience. So yeah.
Yeah, I would love to dig into maybe when there's been several investors that if you got in the 2021, 2022, maybe even 2020 timeframe, I'm hearing a lot of like, man, I'm never going to do syndication again. And, I don't think it's uncommon for one of the first few deals you do as an LP to go sideways because frankly, you don't really know what you're doing, or at least I didn't.
Yeah,
And
and that first deal, just to be clear, was it back in 2018. It wasn't the stuff that went wrong with that deal had nothing to do with the environment, the real estate environment. It had completely to do with the operator.
Sure, sure. What do you think? made you stick with it? I guess part of it's you wanted to be a GP, but you could see firsthand of how things can go sideways. And maybe if you can opine or contribute to, why people might be straying away.
Sure. So I think that the first deal didn't start going sideways until I already was in a couple other deals. I deployed, it's not like I was like, well, I'm just going to do one deal and wait a year or two before I do a second deal. And I had capital to deploy. I wasn't deploying it willy nilly, like, rapid gunfire, but I was already in a couple other deals and the other deals were doing okay. So this one was clearly operator error and it was fixed, or at least, landed the plane safely. The I think that there are a lot of people right now who have had deals that they've gotten burned on, like LPs, right? Specifically, and also general partners. There are deals over the past few years, when the interest rates started going up, right before the interest rates started going up, it was nearly impossible to get a deal that had fixed interest rates. It was possible sometimes, but in most cases it wasn't. And as interest rates went up, it made the debt service, untenable. And so, there's been problems, right? And I think a lot of people have talked about that, and it's very clear what has happened. And I'm not immune from that. I had that happen to me as well, both on an LP side and as a general partner. And I learned a lot of lessons from that. I learned a lot of ways to talk with lenders and negotiate and try to fix things. But I will say that I think that right now, people who have maybe been burned by syndication, who are not doing it right now, is maybe something they should reconsider, because when you look at any asset class, there are times when it's a cycle, right? And there are times when things are going really well, and usually when things are going really well, it's very popular and everybody's jumping in. And then at a certain point, it turns and the pendulum swings the other way, right? And you go down to the bottom of the cycle. And I think if I had to have a crystal ball, which I don't, but if I had to say, I would think that we're pretty close to the bottom of the cycle right now. I mean, who knows what's going to happen, especially with the administration in the White House doing different things with the tariffs or whatever. Who knows what's going to happen? But I don't know that real estate is necessarily going to go down much further. It's gone down a lot in the past couple of years. And so now might be a really good time to be investing in real estate, buy low, sell high. So buying at the bottom of the market, it's a good time. Now it's not popular right now. And so you have to have the stomach for getting into it right now. And it's like, if you think about a crypto, and I'm not condoning crypto, but I'm just saying, like, when crypto had these booms and everyone was getting into it, and then it crashes, and then everyone's like, and then if you got in after it crashed and then it goes back up again, I mean, that's, again, I'm not saying that crypto is even an investment. Some people might just call it speculation. So I'm not condoning crypto, but I just know that's another example that we could point to where there are ups and downs, and there is in the stock market as well. I think now is a really good time to invest in real estate. The deals that we've been finding lately, and I don't do a large volume of deals. Last deal we did was in November of last year. It is now the end of April, right? So it's been 6 months since our last deal, and we don't have anything in contract, although we put an offer in on something today.
Was that your Echelon Park deal?
That is.
Yeah.
But that deal was a great deal. We bought that property at, I think it was like 30% lower than what it had been in contract for a couple years prior. And then there's a whole long story about that, but we got it at a great basis. In the year before that, we did a deal where we got in and we got not only a great basis, but we were able to assume the seller's interest rates. And so we got the interest rates at the time for multifamily were like between 7 to 8%. And we assumed debt at a 3.8% fixed interest rate for the next 7 years. So, there are opportunities that do come up in times like this. If the people who are putting the deals together are, pragmatic about their approach and do it in a smart manner, now can be a great time to invest, I think.
Yeah, I mean, I think I'm with you, right? It's easy to say, hard to do, but investing when it's low, when it's not popular, when there's fear in the streets, I would argue right now there is fear in the streets, in crypto, in real estate, in office, and arguably always some of the best times to make an investment. I think the hard part is if you have money to deploy or if you are fully deployed. Which is a big contributing factor. I think I'd love to pull on the string here of you having a front row seat. You mentioned maybe negotiating better with lenders or getting caught up in the interest rate hike cycle. Maybe what you would do differently moving forward. I think to kind of pitch some of my insights or learnings here. I think one of the things that I focused on was making sure that I focused on fixed rate debt products that had a longer time horizon than 5 years. And that proved to be a smart play. I don't know if that'll, still hold true because asset values still have come down, even though we've locked a low interest rate. So I'd love to kind of get your take on that, but also maybe some things you're going to do differently.
Yeah. Well, look, when I first started off, that's all I did was the long-term interest rates, right? Fixed interest rates for when I say long-term, I'm talking 10 or 12 years of debt. We don't have fully amortizing commercial loans, right? Unless you're talking about like doing a HUD or something like that, which doesn't make sense from an acquisition perspective, right? So I think that what happened with the market and the way things were going in the market, it became impossible to do deals like that. And I had a number of investors, like a lot of investors, clamoring, when's the next deal, when's the next deal, when's the next deal. And I was looking at the market and waiting and waiting and waiting. And it was where it was. And it looked like things weren't necessarily going to change. And that the new normal was to have to go with variable rate. And we did. And we went in with, I thought, an extremely, extremely conservative approach. And we still felt a lot of pain. So I think, no matter what happens in the future, I should say no matter what, because I think you have to understand where you are in the market and what's going on and what the products look like. But I think it will be a very long time, if ever, that I won't do a fixed interest rate deal. However, I want to point one thing out. If you did a deal 10 years ago with a 10-year fixed interest rate, right? You're still having the same problem right now because you're coming up for a refinance right now. Or maybe you came up for a refinance last year or the year before. So you could have been in a fixed interest rate for 10 years, for 12 years, for 15 years. But if your note was coming due, like nobody saw this interest rate spike coming that I know of, and that it would happen so quickly, so fast. And so I think there are people who had fixed interest rate deals who did them 8, 10 years ago and are still still got pinched by this whole thing. I think the other thing that I learned was about understanding who my investors are and their appetite for capital calls and contributions and how much dry powder they have on the sidelines. Because when we go into one of these deals, we're going into this together as a group, as a team, right? And if we run into some unforeseen rocky waters, as a team, we may need to all pitch in to get us out of that, to get us to a safe harbor. And that is something that we had to do on some of my deals, and as a general partner, you bet I put a lot more additional capital into these deals. I lost some money in some deal. Like I got very, very involved and did whatever I could. But at a certain point, my resources are limited, especially when we have a large property and a large investor base, that we do need the investors to pitch in. And so that's something that I'm a little bit more vocal with investors about as I'm onboarding them into my platform. If they're interested in finding out about my deals, just making sure that they kind of understand that like sometimes things go a little haywire. Like they usually don't. And I've always talked with people about the risk involved, but now it's a little bit about more, would you be willing to participate if we did hit a rough patch? Like what is your tolerance for something like that? Because sometimes that's needed.
Yeah, and I think something unique to syndications, if you are new to this type of investing, and you don't necessarily need to participate, but it might be the best thing to protect some of your earlier capital that you invested.
Yeah, and depending on how the deal has been structured, you may be compelled to participate in a capital call. It's one of the things that I warned about in my book, one of the first few deals that I was going to invest in as an LP, thank goodness it wasn't the first one or I wouldn't have known any better, had language that actually compelled you to participate in any future capital calls or you lost your total investment in the deal.
Wow.
Which I thought was outlandish. I would never put any language like that. I mean, in all of my deals as a general partner, it is always voluntary. It is always voluntary, but there can be language that makes it, where there's penalties if you don't. I invested in a deal actually as a totally not real estate related, a tech fund type deal, and it's doing really well. I'm very happy that I did it. But it was you committed to a certain amount of capital, and then there was capital calls along the way over a several year period. And if you didn't participate in one of those, you would lose your initial investments that you had put in, which gave me pause.
Yeah, no sweat.
Which gave me pause, right? I didn't want to lose my total investment because I couldn't participate in, let's say, the last capital call of the capital that was committed. But I ended up doing it. It was a small enough amount, and I felt comfortable with it. But then I needed to always keep that money on the side because I didn't want to lose what I had put in.
Yeah, very, very common in the venture capital fund tech world, the world I came from. So I definitely resonate with that. How did you end up picking the strategy or the market that you're in? So what I'd love to do is kind of transition and maybe take a step back. I think I'm very cognizant of bringing on multifamily operators because there's it can get dry over time. And I think you have this unique approach, and you coach, and so I'm excited to dig in here. But I'd love to kind of maybe help the listener understand. There are so many different strategies that you can pursue. Some you may only know of because you had a mentor. Some look at the whole market and they're like, I think this is the best strategy. How did you go about finding your strategy? What is it? And what have you learned about that strategy, like pros and cons of it over time?
My strategy when it comes to real estate and when it comes to my coaching program and when it comes to life and my community and my family and everything is all one thing, which is all about adding value. That's what I want to do, is I want to add value to the world, and not like I'm curing cancer or, I'm not trying to say that I'm, but I'm just trying to provide some sort of value to people, right? Helping them out. That's why I wrote my book, to help out people who want to invest in real estate deals. Basically, the reason why I wrote it was because I was running a meetup and all these people wanted to invest as LPs and they kept bringing me deals. And I was looking at these deals before the big interest rate run up. And I was looking at deals that were underwritten like just ridiculous. And I was like, I was trying to protect them. And so I wrote the book because I was spending too much time telling people, don't do this deal, don't do this deal, so that I could just put it all into a thing and be like, well, here, just take this book. It's got all the information you need right in there. But I always try to add value. And so that's what I do when it comes to real estate, right? We try to buy properties and make improvements and make them a win-win situation, something that's going to be a win for the tenants who live at the property, something that's going to be a win for the people who work at the property, and then a win for us as investors. We have a profit motive. We're here. It's not a charity. We're here to make money. But I think you can do that and still be an ethical business person and do well and make improvements. And the other way to make money in real estate is by cutting services and cutting expenses as much as possible. I've seen a number of operators who do very well for themselves financially by doing that. But I don't feel like I could sleep at night knowing that I'm doing that to people. It just doesn't seem right to me. So I try to make improvements. By making improvements at the properties, we can increase the income. We can a lot of times decrease our expenses while still doing things like, one of the things we do is we negotiate cable packages. And so we make a profit off of those cable packages, but we also are getting the people who live at the property, like bulk cable internet packages. They actually pay less when they buy it with us, when we do a bulk package, than they were paying when they were paying directly. And we make money from that too. So that's just one example of a way that you can have something that's a win-win, making improvements to a property. When you look at real estate, there are cycles, as we've talked about, right? Real estate market is hot. Valuations go up, then they go down. And there's no way to predict that. So if your business plan is to buy real estate and then sell that real estate when it is valued higher because the market went up, that's all fine and dandy. But I haven't met anybody who can reliably predict when the market's going to go up, how far it's going to go up, and that kind of stuff. But if you could do that, you could make a lot of money. What I realized through my own investing in real estate and experiences over time for the first, 15, 20 years, 30 years that I was doing some real estate investments versus a primary residence and then started dabbling in investing, was that if you buy a property and you make improvements to the property and you can increase your income and possibly decrease your expenses as well, you force the appreciation on the property. You're not just hoping that forces beyond your control lift the market up. Sure, the real estate market in general overall appreciates 3% each year in the US, kind of sort of, depending on what years you're looking at, but long term maybe. But in any given year, it can change. And as we said, these loans are short. So by forcing appreciation, by making improvements and increasing income, you make your asset worth more. And so when you do that, even if the market forces are against you, if you can push it up enough, you have a deal that makes sense. And whenever I do my deals, since the very first deal that I did, when we underwrite it, we underwrite to make those improvements. We also underwrite for where we think that the cap rates are going to be. And I understand that might be for some of the listeners that might not fully understand cap rates, but essentially the cap rates are telling you where the market valuations are. We 99% of the time, and now is a little bit different, but 99% of the time, especially back in 2018, 2019, 2020, we're underwriting for cap rates to go up, which means value is going down. So
which is the conservative way to do it.
Yeah, we would say we're buying this property at a 4 cap, but we know historically this market is actually a 6 cap market. So it's 4 cap right now, but we're going to say we're going to buy it at a 4 cap, we're going to make all these improvements, and we're going to sell it at a 6 cap, and we're going to be profitable. And what happened was for many, many years, it never moved up to the 6 cap. So we were exiting deals after only being in them for 2 years, 3 years, and, in some cases, doubling investors' money in 2 years, because the market stayed compressed. Now, had the market loosened up in a normal fashion, we would have been able to still exit in year 5 and be perfectly fine. What has happened is there's now been what I think is a bit of an overcorrection, and I think it'll come back into balance. And I don't think it's that much of an overcorrection. Historically, yeah, is debt a little high? Yeah, but historically it's not like that crazy debt service right now. Interest rates and things like that. I'd love to see them come down a little. I think they will come down a little, but not back down to where they were before.
I love when operators project that cap rates are, they're predicting for a worse scenario than when they bought the building. Why do you think more operators don't do that? To me, it's like, if I see that, that is what I consider conservative, quote unquote. Everyone says, hey, we do conservative underwriting with air quotes.
I think people don't know about it. That's one of the things I talk about in the book, right? I'm just trying to tell people, you got to look at this and you got to see, what are those assumptions? What is their exit cap rate? Cap rates also don't move in lockstep with interest rates. I talk about it in the book, and I show a chart that shows it, that they don't move in lockstep. Generally, directionally, yeah, sure. But I can tell you different dates where they didn't, where they went in opposite directions. And I'm telling a story at that point in the book about how I went to a seminar. I went to a thing and there was a guy and he was an operator and he was like, interest rates are definitely going down. And I was like, how could you even predict that? And because of that, cap rates are going to go down. So we're going to buy this property at a 4 cap, but we're going to sell it at a 2 cap. And I'm like, that's insane. Like, it didn't make sense to me. So I think a lot of people are just misinformed, or they get sold by a good salesperson who tells them things. And, that's what happens. It's unfortunate. But also depends where you are in the market. Because like right now, if someone were to tell me, listen, I'm buying something at a 5 cap and I'm going to say that we're going to sell it 5 years from now at a 5 cap, and they're keeping the cap rate steady, like, I might not have a problem with that depending on the market and, looking at the deal where, back in 2018, if they were buying it at a 5 cap, I'd say, look, you're probably going to sell it at a 6 or 6.5. But for me, it's been more about looking at historical norms. So I look at historical norms for cap rates. I look at historical norms for rent growth. I look at historical norms for vacancy in that specific submarket. And that's how I can base myself. I look at historical norms. I also look at what the experts are projecting. And I also take my own market knowledge of what's going on in that market. And I kind of, put it all together and, make my own secret sauce or whatever. And come up with data based. They are assumptions, right? They are assumptions. They are our best guess based on the data that we have. But I try to use as much data as I can to inform that assumption.
So, I mean, the audience can scold me in the comments, but I'd love for you to take a stab now that we've said cap rate. What is a cap rate?
Cap rate stands for capitalization rate. The reason why we talk about cap rates is cap rates eliminate debt from the equation, right? Because I could buy a property with a certain kind of debt. Pascal, you could buy a property with a different kind of debt or maybe with no debt at all. And it would be very hard for us to compare two deals that have different debt structures. So what a cap rate does when you're looking at it, it puts it puts debt on the side and it says, what are the returns if you bought the property all cash going to be? So if you put, $100 into a deal and that deal is going to give you $1 every year, then you're getting a 1% cash on cash return, right? That's what a capitalization rate allows you to do. And when you look at commercial properties, they're valued by a formula. And it's a simple formula. And this is the formula they teach at Wharton, at Boston University, in books like mine, in books like Joe Fairless's, like in everywhere. This is how commercial properties are valued. You take the net operating income. So all the income minus the expenses. We're not talking about debt service. Remember, we're putting that on the side. But all the income minus the expenses. And we look at the NOI and we divide it by the cap rate for the area. And that's how we come up with the value for the property. So we know you have to think of it almost like it's not even real estate. It's businesses that you're buying. It's little factories that are generating cash, right? They're cash flow machines. And so if you're buying these cash flow machines, you want to make sure that your rate of cash flow is going to be the same rate as what other people are paying for in that market. You can also do simple algebra and put cap rate on the other side and put value on the other side, and then you can determine what a cap rate is by looking at the value divided by the amount of income that's coming in, and that will give you a capitalization rate. So, that is a nutshell version of what cap rates are. And it's a good way to make sure that when you're buying a property, that you're paying what other people in that same market are paying for a property. And it's also a way for you to say, okay, well, in the future, if this market softens up or the whole real estate market as a whole softens up or tightens up, I think cap rates are going to go up or they're going to go down. And that will change my valuation at a later date and time.
Yeah, I would say that cap rates were the most difficult term for me to understand when I got into this industry. So if you're still on the sidelines scratching your head, just continue absorbing this, and it will slowly come together.
It'll click at some point.
You mentioned a little bit about, okay, you focus on doing value add. Are you in a specific geography? Are there specific types of value adds that you do and value adds you don't touch?
Yes.
Talk about that.
Yeah. Well, I have what I normally do, and then sometimes I do things a little out of the norm. So when I'm talking about what I normally do, I'm normally looking for multifamily assets. I like the Sun Belt. I like areas where I see, population growth and job growth. So when you look at the deals I've been a general partner on, now I've invested as an LP in other markets, but as a general partner, I focus on initially the Kansas City market, and then started doing a number of deals in Texas. Spent years and years and thousands of units in Texas. And then I just did my first deal in a market I've been looking at and studying for quite some time, and that's the market of Atlanta, Georgia. So I'm very excited to be there, and I think we're in a fantastic location. I'm very excited about it. But I live in New York, but I tend to invest in the Sun Belt because that's where the numbers make sense for me. And I do value add. I like to buy properties that are stabilized properties, meaning that they're usually 90% or more occupied, so that we're not really reinventing the wheel here. I do know people who buy properties that are, very, very low occupancy and turn those around, which is wonderful. But I don't have the stomach for that. I want to find properties that look like they're going to be cash flowing from day one, and then make those improvements over time. I do invest as an LP in some, I've invested in some land deals and some new construction deals, in redevelopment of one of my students is doing, which is he took a motel and he's converted it to multifamily. It's very exciting. It's going extremely well. And I'm doing what I consider the ultimate value add right now, which is we bought some properties and we did an assemblage, and we are going to be tearing those properties down. They're defunct businesses, and we're going to be building a mid-rise 9-story property, multifamily property. So that's my first, real ground up development project as a general partner.
Love it. You mentioned your students. So you coach now on the side as well, new GPs, new syndicators, people that are trying to get in the industry and become better. Can you give us maybe an outline of who you're coaching and what you coach them on?
Yeah. The genesis of the coaching came from right a little bit before I started writing the book. A lot of people would reach out to me and say, hey, like, you seem to know what you're doing. You run the meetup, like you have a number of successful deals. I want to do what you're doing. Can you teach me how to do it? And I said, no, I don't, I don't know what I would teach you. I work from home. Like, you're going to like come and hang out with me at home all day and like shadow me. Like, it seemed weird. And I was like flattered, but no. And, as I started writing the book, I also was approached by someone that I had become friendly with, and they were like, no, really, Matt, like really, I really, really, really want you to teach me how to do this. And I succumbed to their pressure and started to teach them how to do deals. And I found that I really enjoyed it. I also found through writing the book, which is really more of like an educational, it's like a memoir, but kind of like educational book, that I enjoyed like helping, like educating about this area, which is something that like a lot of people just don't know about, and just I have a lot of information on. And so that's sort of how the coaching business started, and it's grown from there. I had a couple other people come up to me and approach me, and I took a couple other people under my wing. And then a couple years ago, I said, all right, I put a post on Facebook, and I said, I'm going to take 10 people who want to learn how to do what I do, just respond to this message, comment on this post. And within a couple of days, it was full. And I brought these people on, and they paid me money for it, and I coached them. And as I did that, I was very clear with them on where I was with the program. I had in my head exactly what I needed to do, but I then actually developed an entire curriculum and lots of videos and modules and handouts and worksheets and all kinds of stuff, and developed an entire course. So that took me, I did that post in March of 2023, 2022, I don't know. And then by the end of that was 2023. By the end of 2023, everything was done. And then starting last year in 2024, I really kind of like formally opened up like, hey, I have coaching if you're interested. That's gone very well. I had over 50 people sign up for the program last year, and I did my first conference. I did a conference in New York in January of 2025. And that was open. We did one day that was just for my students, and one day that was open for the general public. And what I do with my students is I teach them soup to nuts, everything when it comes to syndication, from number one, just figuring out like where you are, where you want to be, doing goal setting up, your entities, asset protection, that whole tax efficiency, through understanding how to structure deals, through determining the market that you want to focus on, and then underwriting deals, and not just putting numbers in a spreadsheet, but having, how do you come up with those assumptions, and looking at the financials of the property, and looking at, different data sources, and then ultimately bringing a deal across the finish line. And also part of that is how do you meet investors? Where do you go to meet investors? How do you speak with investors? What information do you share with them? And that aspect of it as well. So it's really a holistic look at building a syndication business, and I'm there to coach and guide them along the way. It's all customized and it's one-on-one. So I work with people sort of where they are. I have some people who come into the program completely green. I have other people who come in with like a really great fundamental knowledge, but just need someone as an accountability coach and as a guide, a mentor, to just kind of help get them to the next level. And so I work with people kind of, it sort of runs the gamut.
So putting my LP hat on,
Yes.
what do you think separates the sophisticated or quote unquote better GPs? I mean, your program is all around helping people become better GPs and syndicators, but I'm imagining that, I mean, like in all areas of life, there are, ones that get it or are better or more sophisticated. And
Sure.
so I'd love to maybe pull out, maybe what are some of those things that we as LPs should consider or look out for to understand who might be a good fit for us to invest in?
Yeah, I think it comes down to track record, is a good barometer at first. So I have a resource on my website that you can download, and it's how to vet a deal, how to vet a syndication, right? And I break it down into three things that I look at. I look at the person who's putting the deal together, the syndicator, and then I look at the market, and then I look at the deal itself, right? So when we're talking about just the syndicator, the general partner, everybody has a first deal. So I don't want to discount somebody only because it's their first deal, but I also want to know that it's only their first deal. And I want to make sure that they have somebody on their team who is very experienced, right? So if I meet you, Pascal, and it's your first deal, fine. Okay, but who's on your team? Okay.
My first deal that I'm raising capital for, because I should have already done a couple deals on my own.
As a limited partner? Yeah. Well, no, I don't think you have to. I don't think that you have to have been a limited partner to be a general partner. I did. I liked it.
Well,
I
I'm
thought
more
it was
thinking.
good.
I'm more thinking like, hey, I don't want to go raise money for from other investors if I haven't done a deal by myself.
Well, then if that's the case, first off, I think there's a difference. Just to be clear, like when you're talking about raising money, I'm talking about people who aren't just raising money for deals, because we're actually talking about people who are actually material participation, right? All of the people that I work and coach with are people who are going to have material participation in the deal, and they're going to bring their skills and their experience to the deal. And their skills and experience might not be in real estate, but might be in other businesses, right? So, for instance, I have a partner that I work with who used to be a Fortune 100, he used to be an actuary for a Fortune 100 company. So he really understands the finances and how to look at finances and how to do all, and that was a tremendous skill set for us to have on our team. So we brought him in on our team to work on our deals. And now he's got a ton of experience doing that with real estate too, but he didn't. He did not have experience doing that with real estate, but he had a relatable skill. I don't think that somebody has to have been an LP in a deal. I've never, you said on their own, I've never done a deal on my own ever. When it comes to syndication deals, I've done some deals on my own, single family properties and things like that. I've never ever done a syndication on my own. I've always worked with other people, especially when it's your first deal. You almost always have to work with another person, because if you have no experience, you're never going to qualify for a loan, unless you have like a tremendous amount of net worth and liquidity, then maybe someone's going to give you a loan.
Yeah, I mean, I think that this distinction I'm trying to make is,
Yeah.
you can have partners for sure, and maybe you pair up with two people that are experienced, and everyone has to have their first deal. And I'm sure there are operators out there that go out and raise LP money for their first deal. But I don't know. Yeah, I maybe sit on the other side of the spectrum where I don't want to have someone learn with my money.
Sure, I can understand that. And that's why I think you need to be careful with who you're vetting. But when we're talking about vetting somebody, if it's their first deal, I don't discount them just because of that. Okay. I want to have I want to, first off, like I said, I want them to have another person who is a partner. And I'm not just talking about like a partner because they signed their name, like they are literally involved in the material participation in the deal, who's very experienced. Right? I mean, when you think about it, if you invest in a real estate deal at a REIT or something like that, there's new people who come on board. There's new employees. When you get on an airplane, there's going to be a guy who it's going to be their first time as the co-pilot or their first time as a navigator. There's another pilot with them who's there helping them, right? But there are people who are new, and I'm not going to not get on an airplane because it's this co-pilot's first time driving. I know that the pilot has, however many millions of hours of experience, then I feel comfortable. And the co-pilot's going to gain that experience. And then eventually the co-pilot could become the pilot, right? So that's how I look at it. I want to make sure that somebody on the team who's actually running the day to day but just because it's someone's first deal, like if the relationship that I have is with someone and it's their first deal and they're bringing me in, I don't have a problem with that, but I want to see a track record on that team. And then I want to understand, I want to talk with them through the deal and understand the deal. And also by talking with them through the deal, I can very clearly understand what their level of experience is and whether they really understand the deal or not. And that's usually the dead giveaway for me.
What does that look like? Like, I'm an LP listening to this and I'm like, Matt's talking about how do I talk with this operator to understand if they know what they're doing. I, especially if I'm not as experienced as I could be.
Sure.
What does that mean? What does that conversation look like?
Yeah, well, so in the book and on the free resource, I've got a number of questions that you can ask. Track record's one of them, but I think it's about getting on a phone call and really talking through the deal itself. I want to understand the mechanics. I want to understand the underwriting and exactly how they came up with everything that they came up with. Most of the time when I find people and it's their first deal and they don't have an experienced person on their team, they don't know what they're doing and they don't know what they're talking about. And then they can't explain a lot of the questions, answer a lot of the questions that I have. And that's one of the things that I try to make sure that my students can answer those. I want to make sure that they really do understand their deal inside and out. So that they can answer questions that come up. And also want to make sure that they're teamed up with somebody who's got a track record and has experience, who can be their co-pilot, who can help make sure the deal gets across the finish line in a good way. I mean, the things that you want to talk with them is question their assumptions about rent growth, about vacancy, about the cap rate, what kind of debt they're getting, why is their debt structured this way, assumptions about rent increases, and why are the rent increases the way that they are, and how did they come up with, one of the things I like to look at is the variance between the T12 income and year one income. And sometimes I see these guys who underwrite like, oh yeah, there's a 30% increase. And I'm like, how is that even possible? So, there's a lot of different things when it comes to the mechanics of the deal and the underwriting of the deal that I think you need to understand as an LP, and then you can question your GPs about it. So the most important thing I think is to get educated. I had a phone call a couple of days ago. Somebody filled out, I have like an investor interest form on my website. And if you're interested in investing in my deals, you fill it out. And so someone did, and I had a call with them. And this person like clearly had no knowledge of real estate at all, like zilch, zero, nada. And wanted to invest in my deals. I told him, I'm like, look, I don't have a deal at the moment, but even if I did, I wouldn't let you in the deal for two reasons. Number one, well, some of the deals I do, you have to be accredited, and this person was not accredited. I said, but even if you were, if I was doing a deal where you didn't need to be accredited, you have to be sophisticated, and you're not sophisticated. But also, I wouldn't feel comfortable taking your money regardless of the the SEC rules, because I really don't feel like you understand this. You don't understand how these deals are structured, and you don't understand the risks involved in like what could go wrong. So what my recommendation to you is, and I gave them a list of a few different books, including mine, to read. Also, I have a free YouTube channel with like tons and tons of like detailed content. I'm like, but there's tons of podcasts out there. There's tons of YouTube channels. There's like lots of free resources that you can go to learn this stuff. And I think it's really important that you learn it and then like come back to me in like 6 months and let's have another conversation. And, I'd love to, I need investors. I'd love to have you invest in my deals, but I want to make sure that you fully understand it. And so the thing I would say to anybody who's listening to this podcast is that you should do that education. But I also feel like the people who are listening to this podcast maybe don't need to hear that because they are here. They're on this podcast. They're learning about this. They're digging in and starting to understand all the nuances of what goes on in these deals and probably buying a couple of books and watching a lot of YouTube videos and listening to this podcast and maybe some others to gain that knowledge. And then have a conversation with the GP. And if the GP won't get on the phone with you, don't invest in their deal. And if the GP is kind of a jerk on the phone, don't invest in their deal, right? That's also part of it. One of the things I talk about in one of the questions is sort of what is that GP's investment philosophy and what are their values? And do they share the same values as you? Are they I talked earlier about the sort of scorch the earth mentality of like, we're just going to cut services and bring the expenses down as low as possible on this property and increase our NOI and make money. And you can do that and you can make money. The first deal that I was going to invest in as a passive investor was run by someone who did that. And I actually went and I saw the properties that they were working on. And I said, oh my gosh, I don't think I can. This person has a great track record, but I don't think I can invest with them because I don't morally agree with what they're doing. Like they're really, it was a bad situation. So I didn't. And then I found somebody else who was, again, not doing charity, but like making properties look nice and like making improvements for people. And, that's a big thing for me at my properties. We do something every 6 weeks at our properties to help the residents by, sometimes we do like a surprise and delight breakfast sandwich around Thanksgiving. We give away free turkeys. We do all kinds of different things. I could go on for hours and hours about all the different things. We do one every 6 weeks, but to make improvements for people's lives. And so people who really just care about the bottom line and the dollar will invest with that other person. People who care about investing in something that is like has some sort of conscious to it and also makes money and has a good track record will invest with me. That's an important factor as an LP that you also need to look at.
Matt, I appreciate you spending the time here and influencing us, helping us understand a little bit more about your world and what you do. Tell us where we can go learn more about you, getting into your deals, your coaching.
Yeah. You can find everything at picheny.com, and I'll spell it real quick. It's PICHENY.com. There you can sign up for my free newsletter. You can, at the bottom of every page are my socials and my YouTube channel. You can I have free downloads of educational resources. So check it out.
Love it. Love it. And if you're listening here and you want to access deals like Matt's, anything that's a 506c oriented deal that I come across, you can find that at the passiveinvestingstarterkit.com. And you can get more deal flow like that. And hopefully Matt will be on the next one when his next deal comes out. And with that, we are here on the Passive Income Playbook, part of the Best Ever CRE show. We drop new episodes every Thursday. So if you love these, be sure to tune in. And, all of our resources or everything that I interview around is to help you become a better LP investor. So if you enjoyed today's episode, be sure to subscribe, leave a review. It really helps us reach more investors like you. And thank you for tuning in. We will see you next week for another episode of the Passive Income Playbook.